Welcome back to another issue of smarthelping.com, and today, this week, Thanksgiving week, I have built an Excel model. This is something I did for a client, but I've modified it a decent amount to work for anybody. And the point of this financial model is to help you determine what you want to charge as an insurance package if you're selling a product or service. So the general layout here is anything in this light yellow color, or what, I'm colorblind, so I think it's light yellow or lime. You're going to change based on what these values are to you, and then based on that, it's going to give you some visuals here on insurance package prices you want to charge based on your desired percentage return on the risk you're going to have to pay out, assuming, and we'll go through the assumptions on our build tab. Now we have another visual we'll go over, and we have our table here. So to understand what's going on, let's just start from the top. So let's say you offer automotive services, and you want to offer people a free, if they come and get a transmission service job or something. Let's say you want to say if you buy insurance, say X amount of dollars, then we will repair any more issues with your transmission that happens in the next year or 2 years or however many years, and do it for free. So how now you as the business owner need to figure out, well, how much do I need to charge to make sure I have enough reserve to cover all of this possible insurance risk or insurance claim risk? And then do you also want to make a profit from that revenue to help ensure that you have enough in your reserve to cover anything that happens? And so then you can build everything out based on that. So here I just did, for an example, for say X whatever insurance claim, if they do successfully file a claim and you do have to pay their costs, I have all the different costs here. 5 different costs you can lay out, and this is saying, well, every single insurance claim that we have to process is going to cost $9,527. So now you know how much it costs. Now you need to know what's your risk percentage of the insurance claim happening. So here we have just an example, expected product or services where insurance is bought. So let's say you do, I don't know, 1,000. 1,000 people buy your insurance package that you sell with your product or service. Okay. And then you got to put what is your expected number of occurrences that a claim will happen. Of that 1,000. So here we put 1. Let's say 1 in 1,000. Let's say it's, I don't know, 5% risk in the first year, or whenever, however you are structuring your insurance package. Let's say 50. So you got let's say 25. So you got a 2.5% chance of occurrence. So based on that, we're now going to go to your desired return on risk. So this number is just saying based on these percentages and the amount of actual packages you sell for products and services, you're going to have some kind of cost that you got to pay out for claims. So based on that predicted cost that you're going to pay out, how much money do you want to make on top of that as revenue, extra reserve, etc.? So let's say 100%. Well, that's just going to mean your needed revenue your revenue is going to be double whatever it's going to cost you. So you can see that doubles everything. So let's say 0%. Well, then that means your revenue here is going to be the same. That means you just covered what you thought it's going to cost. Let's say you want to make 25%. There's that. So these are all 25% chance increases. And then your insurance charge to the customer here is just taking these total revenue returns divided by the total number of insurance packages purchased, and you get a number. So this is 297.72. This is saying that if you have whatever amount of customers, if you want to get 25% return on your risk, every single customer has to be charged $297.72. And that will mean they get this amount for free, this amount of work done, $9,527 of work done. And then so you need to charge $297.72 per person to cover that. So you can see, I mean, if three people have a claim, that's just going to be all these costs times 3, so $23,000. Now, for every 3 people that have a claim, you need enough revenue to cover that. And based on this risk of 2.5%, now let's do some easier numbers. Let's say you got 100 people. For every 100 times, let's say it's 25. That makes it real easy math. So your risk of occurrence is 25%. Here, now look at how much you got to charge. If you say 1 in every 4 people are going to have a claim, and this is what it costs to pay out the claim, you're going to have to charge every person $2,977.19. And then here you can see, in this case, 100 qualifying patients, 25 insurance claims, 25,000, 6,250. To pay for that 6,250 is going to cost you $59 million. So for those 25,000 people, they each have to pay in $2,977. So you have enough to cover that. And let's say this is back down to, let's put this back down to 1. Now you can see, well, in 25,000 insurance package purchases, you're only going to have to put out claims for 250 people, which is going to cost $2 million. So for those 25,000 people, you charge $119 each. Your revenue is $2.9 million. You now have covered that, and you've made a little bit of extra for your reserve. So you can base this. It's all going to be driven on what is your percentage of occurrence, and then your costs. And that's it. And then here's just a projection. This kind of helps you see what it looks like for different scenarios through this. But this will not change. See if I put 1 here or whatever. It won't change this number, insurance claim or insurance charge to customer. Okay, so now you know how it works. Here's just a visual. First thing we have is based on your desired percentage return, how much you need to charge each customer, and that is all driven off of this. So you can see right now $95.27 to break even if you want to make 0%. Let's say we go back to 5%. Now this should go up. Yep, now look, you got to charge $476 a customer. And it goes up from there. Now we also have this chart which shows how many insurance claims are there per given insurance package purchased. Well, per total insurance package purchases. So here you got 25,000 purchases. Well, that means you're going to have 1,250 insurance claims. And this is all just a ratio percentage based off of this again. So if this was 5, visual, or hold on, let's see. Oh, now what happened? Is my Excel sheet lagging? Oh, whoops, I accidentally put in 5% there. So if this was 5, that's at 1250. Let's put it up to 10. Now you can see, oh, 25,000, you're going to have 2,500 claims. So that's just a nice visual to show the curve. Then our tables over here, this is a nice chart to see based on your desired percentage return, 0 to 100%, how much are you going to have to charge each customer to cover that. So at 0, this is your break even, pretty much $952 in the current scenario. And you can see that'll match if I put this at 0. Sorry, not that. If I put my desired return on risk at 0, this 952.70 should match. Yep, 952.70. If I wanted at 90%, 18, 10, 13. You can see there 18, 10, 13 at 90%. Alright, that's the model. Now, I'm going to start with a pretty fair price on this. I think I'll do $50, and that will get you this whole Excel sheet, and I'll walk you through any issues you need or tailor it to your specific situation. Just a one-time fee, and I'll give you the sheet. Now, if you want to play around with it, I will give you a free version, which is all protected, so it won't, like, none of the Excels will allow you to change anything. It won't work, but you can just see the layout for yourself, and that's free. But if you want a fully functional sheet, $50 one-time fee, you can get that. Just go to the link at smarthelping.com. The link will be in the description box below. You can go check it out. Alright, that's all I got for you this week. We'll see what I come up with next week.